Hey everyone, and welcome. In this video, we're going to unpack one of the most important pieces of the apparel sector, footwear and sportswear brands. We'll quickly walk through what sits inside this block, how these businesses make money, who the customers are, how macro cycles hit them, what has changed in the last 3 to 5 years, and finally, how the future might play out under different scenarios. I'll keep all the key numbers and examples in, but in a tighter format, so you can see the economics clearly before you ever touch a stock. Let's start with what this block actually is and who the main players are. Footwear and sportswear brands are consumer brands whose core business is shoes and activewear. On the footwear side, that spans running shoes, trainers, sneakers, hiking boots, sandals, fashion boots, kids' shoes, and court shoes. On the sportswear side, it's performance tops, leggings, shorts, outerwear, team kits, and fanwear. Most of these companies design the products and control the brand, but outsource manufacturing to factories in Asia. They sell mainly in two ways: wholesale to sports chains, department stores, and online marketplaces, and direct to consumer through their own stores, outlets, websites, and apps. You'll see three broad types: global giants with multi-category sports and lifestyle ranges, regional brands focused on a specific sport, price point, or geography, and challengers built around a sharp angle, like maximal cushioning, an eco-story, or a niche sport. They sell more than products. Around the shoes and apparel, they build apps, run clubs, training plans, events, digital communities, and loyalty programs. They also sell brand meaning, identity, performance, lifestyle, community, and status, especially via sneaker culture and collaborations. Think of a stack: core footwear, then apparel and accessories, and above that, digital services and brand. Most customers are consumers, everyday users wearing sneakers and athleisure as a uniform, athletes and fitness users, and parents buying kids' shoes and kits. There is a smaller B2B slice selling kits to clubs, federations, schools, and corporates. In the value chain, these brands sit at the downstream brand and retail layer, relying on upstream textiles and factories for materials and assembly, and distributing through online platforms, wholesale partners, and off-price value retailers. They compete with broader apparel and lifestyle brands for the same wallet, but with a stronger performance and sports lens. To ground this, here are 10 illustrative examples, not recommendations. Nike leads globally across running, basketball, and lifestyle with 45% gross margins and low teens operating margins. Adidas is strong in football and lifestyle with 2024 gross margins 50 to 51%. Puma focuses on performance and lifestyle, notably football, motorsport, and streetwear. Skechers targets value to mid-price comfort and casual footwear via wholesale and owned stores. Deckers Outdoor owns Hoka and UGG. Hoka drove 18% revenue growth and 50+% EPS growth in FY 2024. On Holding is a premium running and lifestyle brand with cloud cushioning, 20 to 30% plus revenue growth, and 60+% gross margins. Under Armour is performance-led, apparel-heavy, but with meaningful footwear. ASICS is a credible running specialist with a growing lifestyle side. In China, Anta Sports operates major brands including Anta and Fila China, while Li Ning blends performance and streetwear and is gaining younger consumers. Among challengers, On Holding combines wholesale with fast-growing DTC, nearly half of sales, premium pricing, and limited discounting. Allbirds built a sustainability-led DTC model using natural materials, but revenue is down 25% with ongoing losses, showing that sustainability and DTC alone lack scale economics. With the players, customers, and value chain position defined, the next step is business models and economics, which will clarify later sections on customers and cycles. There are four main business models: Wholesale-led brands sell to retailers, sacrificing margin for lower fixed costs and capital needs. Omni-channel leaders like Nike and Adidas mix wholesale with DTC, stores, outlets, websites, and apps, gaining higher gross margins and better customer data, but taking on greater store, logistics, and tech costs. DTC-heavy challengers such as On and early-stage Allbirds rely mainly on digital channels and a few flagships. They can scale quickly but face high customer acquisition and returns costs. In addition, brands earn licensing and endorsement-driven revenue using license categories and sponsorships to extend reach. Capital is concentrated in intangibles, brand, design, and athlete deals, product creation and R&D, cushioning, materials, sustainability, and inventory, which carries seasonal markdown risk. Larger DTC footprints add stores, distribution centers, leases, and physical assets, alongside ongoing spend on apps, e-commerce, and data infrastructure. The global athletic footwear market is about $130 to $140 billion in 2024, growing at about 4 to 5% CAGR into the early 2030s, while the broader sportswear market is about $200 to $330 billion plus, with mid to high single-digit growth. For leaders like Nike and Adidas, gross margins typically run 44 to 51%, with operating margins in the high single digits to low teens. The economic logic is simple. Scale in design, marketing, and sourcing lowers unit costs and spreads endorsement and R&D spend, while strong brands sell more at full price, discount less, and retain pricing power when input costs or tariffs rise. Channel mix matters. More DTC usually lifts gross margins but raises fixed costs, making returns dependent on store productivity and online unit economics. Inventory discipline is critical to avoid heavy markdowns and off-price leakage. 5 factors drive profitability. Sports participation and athleisure support demand and steady replacement cycles. Innovation in technology and design enables premium pricing and repeat purchases, while weak product cycles quickly force discounting. Brand heat and cultural relevance through collaborations, athletes, and pop culture keep products in the must-have category. Supply chain and tariff management matter because production is concentrated in Asia, notably Vietnam and China, where labor, FX, and tariffs affect costs. Diversified sourcing reduces shocks. Finally, data and channel strategy, using app and e-commerce data for planning, lowers inventory risk and customer acquisition costs. Structurally, the market is concentrated at the top and fragmented below. Launching a small sneaker brand is easy, but scaling profitably is hard without differentiated products, sustained brand investment, and supply chain access, making entry easy at micro scale, but moderate to high barriers at real scale. We've now covered what this block is, how money flows through it, and the key market sizes and margins. With that framework, the next section on customers and behavior will show how these numbers play out in everyday demand. Customers fall into a few clear groups: everyday users who wear sneakers for commuting and casual life, sports and fitness participants buying performance footwear for running, gym, and team sports, fans and collectors purchasing jerseys and limited drops, and kids and teens, important for school, sports, and fashion identity. Use cases are straightforward: daily wear, training and matches, specific events, and status moments around collaborations. Most people wear branded sneakers daily, often rotating 2 to 3 pairs. Everyday shoes are replaced every 12 to 24 months, while running shoes turn over faster, about 6 to 12 months, or 500 to 800 kilometers. Loyalty can be strong, but switching is easy unless brands reinforce stickiness through apps, loyalty programs, communities, and run clubs. On pricing, value brands sell around $40 to $70, mainstream brands $80 to $150, and premium or collab models $150 to $250 plus, usually with small baskets of one pair. Strong brands earn 40 to 50% gross margins, consistent with Nike and Adidas's 44 to 51%, translating into 8 to 12% net margins in good years. Choice looks vast, but sales concentrate in a few core franchises. Customer growth comes from rising sports participation, especially in emerging markets, and greater activity among women and older consumers, driving mid-single-digit revenue growth industry-wide. With who buys, how often, and what they pay clear, we can now step back to macro cycles and sensitivity, which explain how this segment behaves when the economy turns. Footwear and sportswear are discretionary but more resilient than fashion. When incomes fall, people usually delay purchases rather than stop. Kids keep growing and serious runners still replace shoes. Basics like school shoes and budget trainers behave semi-essential, while premium collaborations are clearly cyclical. The if-then logic is simple. When jobs and incomes are strong, consumers trade up, buy more pairs, and pay closer to full price, lifting premium performance and lifestyle segments. When inflation and rates squeeze wallets, replacement cycles stretch, promotions matter more, and shoppers trade down to value and off-price, pressuring mid-tier margins. On costs, strong brands can offset higher labor, freight, or materials through pricing and lower discounting, while weaker brands rely on promotions and see margins compress. Tariffs, FX moves, and sourcing concentration raise risk. Diversified production across countries like Vietnam, Indonesia, and China reduces shocks. Tighter ESG and labor rules favor brands with strong, traceable supply chains and hurt non-compliant players. Behaviorally, demand is habit-driven. Running and gym routines create repeat replacement cycles, so revenue is often shifted, not destroyed. Shoppers are price-sensitive for core products, but accept high prices for hype drops. Comfort, fit, and community build loyalty, yet switching remains easy if those weaken. So this segment isn't defensive, but it has buffers, habits, replacement cycles, and a mix of basics and premium. With that, we can now look at what's changed in the last 3 to 5 years and how power and profit are shifting across the value chain. Over the last 3 to 5 years, several structural shifts have reshaped footwear and sportswear. Athleisure is now everyday wear, moving from the gym into daily life and taking a larger share of wardrobes and spend. At the same time, demand has shifted toward premium comfort. High-cushion shoes like Hoka and On have grown rapidly, with max cushion designs crossing from performance into lifestyle. Digital discovery now dominates. TikTok, Instagram, and YouTube drive reviews, outfit inspiration, and faster trend cycles. Sneaker culture and resale have intensified, with limited drops and collaborations creating scarcity, hype, and high resale markups, mostly captured by platforms and resellers, but shaping how consumers value products. Distribution and monetization have evolved. Big brands push more sales through DTC apps and loyalty ecosystems, while marketplaces and specialist online retailers remain central. Resale platforms have become core channels, reinforcing ideas of lifespan and collectability. On costs and regulation, tariffs and trade tensions have shifted sourcing from China toward Vietnam and Indonesia. Innovation has accelerated in foams, plates, uppers, and recycled materials, informed by data from wearables and apps. Freight pressures have eased since the pandemic, helping margins, but wage and energy costs remain elevated. The result is a power shift toward large global brands, which benefit from scale, data, and pricing power. Challengers can still win, as On and Hoka show, but only with strong technology and brand stories. Others, like Allbirds, with 25% revenue decline and ongoing losses, highlight how high the bar has become. These shifts reinforce brand power and raise entry barriers, setting the stage for a future outlook and scenarios across the near, medium, and long term. Most forecasts expect athletic footwear and sportswear to outgrow overall apparel, compounding at mid to high single-digit rates over the next decade, driven by health, wellness, and emerging markets. Near term, 1 to 2 years, sportswear remains everyday wear, with sneakers and athleisure core to wardrobes. Global leaders should keep dominance in marketing, sponsorships, and shelf space. The category stays discretionary but more resilient than fashion, with basics and performance holding up better than trend-led items. Some DTC-only brands will keep shrinking or exit, as seen with Allbirds' negative 25% revenue decline. Growth should concentrate in premium comfort and performance niches, max cushion running, trail, outdoor, and small court sports. DTC penetration rises modestly, wholesale stays key, and strong brands try to protect pricing amid cost pressure. Medium term, 3 to 5 years, the sector should still grow faster than GDP, with an oligopoly at the top and a long tail below. Product innovation, brand investment, and balanced wholesale DTC models continue to work. Undifferentiated mid-tier brands and growth at all costs DTC models likely fade. Digital ecosystems deepen, segmentation improves, and sustainability becomes mainstream. Long-term, 7 to 10 years, core needs persist: performance, lifestyle, and identity, but linear, non-recyclable models weaken. Growth shifts toward premiumization, circular models, smart footwear niches, consolidation, and rising Asian brands. In bull, base, and bear cases, outcomes hinge on product differentiation, brand relevance, and financial discipline. Strong brands compound, weak ones consolidate or disappear. That's the full picture of where this block is headed.